Hi, I'm John Slater, and this is Capital Matters. It used to be, certainly when I started my career in law and then in investment banking, that commercial banks were there to support good entrepreneurs as they grew their business past the startup stage to a point where their revenues were growing, their employee base was growing. Bankers would find a way to make loans even though there weren't necessarily clear-cut asset support for them, because they trusted, they knew the character of the entrepreneur, and they had enough judgment to understand who was going to pay them back and who wasn't, and it worked well. That world has changed. Banks, for a variety of reasons, not the least of which are their own regulatory constraints, really aren't there. All they can do is provide asset-based loans, particularly those that are backed by commercial real estate, and that puts many entrepreneurs in a bind. We're going to talk today about one of the alternatives for entrepreneurs who no longer can depend on the banks, and that is mezzanine finance. And we're taking the occasion of a closing of a mezzanine transaction that we just put together for a good small company that fits the category I just described, a company called Paramount Merchant Funding. Paramount is a relatively young company founded by some quite young entrepreneurs, the types of really winners in the business community that we want to see supported. Obviously, we can't tell you any of their secrets in reviewing how a mezzanine transaction works, but we're going to tell you a lot of the details that go into this type of lending on a general basis. So, what is a mezzanine loan? A mezzanine loan fits in the typical company's capital structure between senior debt, which today is quite often asset-based debt secured by inventory receivables and hard assets, and true equity, either the entrepreneur's equity or equity from a third party, such as a private equity firm or a venture capital firm or angel investors. And mezzanine differs from senior debt in particular in that it is covered or supported by the cash flow of the business, not by specific asset coverage normally. And so the mezzanine lender has to truly understand the dynamics of the business and to be assured of repayment. In addition to the actual cash flows, the lender is also depending on, in part, the existence of a ready market for good companies so that in extremis, the company can be sold and repay the debt. Obviously not what the entrepreneur wants, but it is makes it possible for these lenders to get involved in a type of financing that the banks just won't do. Mezzanine debt is more expensive than bank debt. Typically carries a coupon, cash current pay coupon in the low teens, perhaps some payment in kind coupon that'll take the total interest rate up to the mid-teens, and then depending on the size of the company, the risk, probably some warrants for smaller companies so that the investor can profit should the company do particularly well, taking the total return up into the high teens. These warrants, even though they technically take the form of equity, really aren't equity ownership. The lenders expect those warrants to be bought back by the entrepreneur, so they're really another way of providing interest but deferring that interest and making it somewhat contingent on the success of the business. These loans are certainly much more complex both to originate because the lender needs a lot more information about the borrower than a bank would if they were securing the loan, again, with a piece of commercial real estate or the private assets of the entrepreneur. they've got to satisfy themselves that the business is going to be a success. So that takes a great deal of information, ultimately of due diligence. The legal documentation can take quite a bit of negotiating. Typically there has to be an intercreditor agreement between the mezzanine lender and the senior lender. That can certainly be complicated, but when you put all this together, what this does is it provides the borrower, the entrepreneur, with the opportunity to grow his or her business in an environment where they would not be able to do so without this type of capital. Since this type of financing is going to be new to many business owners, what we are doing here is providing a brief tutorial on how do you go about preparing for and arranging for a mezzanine financing. I'm going to provide a link on the website to this PowerPoint that you can see by the video. Feel free to download it, and we'll be happy to share with you what we know. And by all means, if you feel comfortable and think you can put this together on your own, certainly go for it. We're not too worried. We know that this is a very grueling and difficult process, and most business owners would rather be running their business, and that's why we have a business in helping them arrange these sorts of loans. But basically, what we're going to cover here is, you need to make your case, just as you would in a lawsuit. You've got to identify who are the prospective lenders. You got to be able to make contact with them in an effective way. Get information before them in a way that they're willing and to focus on. You've got to be able to follow up on a regular basis. You've got to sell. There's a lot of selling that goes on here. You've got to be able to negotiate because these are complex deals. And to negotiate, you need the experience of how are these deals structured, and where the flexibility, where are the rigidities of the lenders. You've got to go through an intensive due diligence process and be prepared for that, or you'll lose the confidence of the lender if you're not prepared to show how good your business is. And at the end, you've got to make sure you manage the lawyers, because they can slow things down, they can create obstacles, they can keep deals from happening. They're certainly a necessary part of these transactions, but clearly you've got to be prepared to get over all those obstacles that are going to be coming up in the documentation process, and push to close. Somebody's got to force the transaction to actually get to the goal line if in fact money's going to change hands. So when we make our case, or our client's case, in arranging a mezzanine loan, or frankly in any other transaction, an M&A transaction or another type of debt or equity placement, what we're doing is not unlike what a lawyer does in preparing a case for trial. We go through an intensive process of discovery, of due diligence, to understand what the client's business is, what are the positives that can be highlighted, what are the negatives that are going to come up during the process, and so we can be prepared to present those in a way that explains, not explains them away, but explains why they shouldn't prevent someone from wanting to lend to the business. Usually we have to help in preparing a financial model. Clearly, since this is a forward-looking exercise, the lenders typically want to see a very good model of what the client expects his business to look like, at least over a 2 or 3 year period. And for many of our smaller clients, this is an exercise that they really haven't been through before. So we can help in doing that. Hopefully, in our experience, it's much better if the client has sophisticated internal accounting team that can really do most of that work. We also have to have a sales document, what we call a confidential information memorandum, which is a book you can see over here to the right, what those look like. But also other forms of communication, a PowerPoint presentation that we work with the client so that when they do meet with prospective lenders, they can present their case in a very orderly way, and a blind summary that goes out to prospective investors, so we can weed out the ones that are not particularly interested, and hone in on those lenders that are going to truly be interested in the deal. Our current list of mezzanine lenders exceeds 300. Now, not every one of those lenders is going to be interested in every type of company. Some want larger deals, some want smaller deals, some like particular industries, and so forth. But it is a very complicated environment, much more so than basically the number of bank lenders or asset-based lenders that would be available to a particular company. We maintain our own proprietary list. We subscribe to databases. We do a lot of research on the internet on an ongoing basis because there are always new entrants into the field. We work with a company called Axial Market, which we're very high on, that helps us present deals to lenders that we might not otherwise know. We network around the marketplace. We're always finding that people are open and willing to share with us ideas if it's not their deal, but they know other lenders. That networking can be very valuable, and we collaborate among our own team in order to maximize the value of the relationships that exist within the firm. But at the end of the day, this is a sales process. We've got to make contact. That's hard to do in the world today, where everyone is protected by electronic gatekeepers. We use a lot of email. We use physical mail, but the main thing we use is the telephone. And you've just got to keep calling if you want to get a deal done. It's a lot of hard work, and you've got to break through the attention barrier. Anybody that can do your deal is going to be seeing literally hundreds of deals and picking just a few out of those hundreds as the ones they're actually going to do. The information sharing process, first we do not disclose our clients' confidential information too early in the process. So we look for non-disclosure agreements before we start sharing any meaningful information, and we spend a fair amount of time trying to qualify the prospective lenders, so we're not sharing our clients' confidential information with parties that aren't seriously interested in the transaction. We do, at the end of the day, we need to have our client in direct contact with the prospective lender. These transactions are all about trust, so the lender needs to get to know our client and develop a degree of trust that our client, in fact, can deliver when the time comes. Since this is a very big, complicated market, clients are all over the country, as are the lenders. We've gotten to the point where we use a lot of video. I think if you've watched any of our presentations, you know that's something that we're big fans of. And once you're in front of investors, you've got to follow up. You've got to sell, and you got to negotiate. Ultimately, what you're trying to do is negotiate a letter of intent, which we work hard to develop a letter of intent that deals with all the material issues, so that we're not going to be renegotiating the deal when it comes time to do the final loan documentation. More and more, due diligence has become a major issue, not only in financing transactions, but in the M&A world as well. And deals take a lot longer than they used to. they certainly can fall apart if the client is not prepared to effectively respond to due diligence requests. So, we spend a lot of time with our clients making sure they are ready, as if they were preparing for an audition so they can be part of a Broadway play. They want to have their act together. They need to pull together a lot of information, put it together ideally in a electronic deal room where when it comes time to actually respond to due diligence request from a particular lender, they can very quickly and efficiently get that lender the information they need. And really the key goal in all of this is demonstrating the client's professionalism to the lender, because that, as much as the actual facts that are coming out in the due diligence process, the competence and professionalism of the company is really the thing that the lender is most interested in seeing. And finally, we've got to push to close. The lawyers, certainly not to slight them, and I certainly have spent a fair amount of my life on their side of the table. But their job is to look for the could go wrongs. That has a tendency to slow down the process. Can certainly, by identifying those could go wrongs, create friction between the lender and the borrower. So our job as an intermediary is to bring the parties together, get over those obstacles, and as I tell my clients, and there's a little hyperbole here, but not much. There's never been a deal that I actually succeeded in closing that didn't fall apart 5 times. Now, that's not saying that there weren't deals we had that only fell apart once, because that's all it takes for a deal not to happen. So if you have any questions about mezzanine financing, feel free to give me a call. I'm passionately interested in helping entrepreneurs grow their businesses, and happy to share what I know. Whether or not you're interested in my professional services, I'll certainly be happy to provide you, my perspective on the market and what's available out there. So I wish you luck and look forward to talking to you again in the near future.